Hi everyone, I am Asif Iqbal, business lecturer in Scholar School System. I am here with you today to explain about the Lecture 3 presentation of financial statements of Module BMM4133, Principles of Accounting and Finance. So first of all, I will discuss with you the learning outcome that I will cover in this PowerPoint. That is the prepare a company's financial statements using the relevant international financial reporting standards. What are the objectives of financial in accounting? There are two objectives of the financial accounting. One is financial performance and one is financial position. Financial performance shows the profit or loss of the business over a period of time, which includes in the income statement. While the financial position shows the assets and liabilities position along with equity at a given time, which came in the balance sheet. Classification of asset. An asset is an economical resource that a business owns or controls, resulting from the past events with expected future economic benefit. These are main two types of assets. One is non-current assets and others are current assets. Non-current assets are those which are held by the business for more than 12 months, which includes property, building, machinery, vehicles, and these non-current assets support the business operations and generate income over a long time. While on the other side, the current assets, which is used less than 12 months and are expected to convert into cash within a year. The examples of current assets include cash and bank balance, accounts receivables, inventories, and these current assets are crucial for day-to-day operations to meet the short-term obligations and maintain liquidity. Non-current fixed assets. First one include tangible assets. Tangible assets, those which are physical assets held for long-term use, like the land, building, machinery, plant, furniture, and fittings, motor vehicles. And the depreciation is used to over the cost of the assets, while over is useful life. These are two main methods which is used for depreciation, a straight line and the reducing balance. Straight line method, when the same amount is depreciated each year, while the reducing balance method, the amount of depreciation is high in the early year and going to be reduced in the coming years. Intangible assets are those which with no physical substance but provide value to the business, like the brands, patents, goodwill, and similar to depreciation, it applies to tangible asset is called amortization. And the one more thing in the fixed assets, the non-current assets, that includes the investment held for the long-term returns as shares in the other companies. Liabilities. Liability is obligation that business owes to others resulting from a past transaction, which require a future outflow of the economic benefit. Liabilities are divided into two main categories, current liabilities and non-current liabilities. Current liabilities are those which are due for payment within 1 year from the financial statement date. And non-current liabilities are those which are due after more than 1 year from the financial statement date. The current liabilities include trade payable. The trade payable amounts owed to the suppliers for goods as of the purchase of credit, but not yet paid. In current liabilities, the accruals are also mentioned. Accruals are those amounts owing for the services expenses that has been incurred but not yet paid at the reporting date. Bank loans, overdraft, short-term bank loans from a bank, overdraft that are repayable within 1 year. The working capital definition also provided here, the difference between the current assets and current liabilities, which indicates the liquidity and the operational efficiency of the business. While the non-current liabilities include the long-term debt, that debt which is due for repayment after more than 1 year from the financial statement date, like the 5 years bank loan used for purchasing any machinery or property or any other equipment. The provisions are the other one that estimate of potential liabilities when there's uncertainty regarding the amount of the timings. Equity. Equity represents the ownership interest or the capitals of the owners, shareholders in the business. It is the residual interest in the assets of the entity after deducting all its liabilities. The formula is assets minus liabilities equity. The shareholders or the owners of the business have a claim to the residual wealth. They are the entitled to equity, which includes share capital and the retained earning. The profits, business earning also added to the share capital. The statement of financial position, also known as balance sheet, which provides a snapshot of the business financial situation at a specific time. And the equation for this one is assets is equal to liabilities plus equity. If you just check the sample of the balance sheet, on one side, all the assets are listed down, and on the other side, liabilities and equity list down. And the total of the assets is equal to the total of liabilities and equity. So this is a sample for the balance sheet. And in all the balance sheet, total assets should always be equal to total liabilities and equity. So summary of the main points of statement of financial position, it includes non-current assets, current assets, current liabilities, non-current liabilities, capital, equity, the profit, which is added in that one. The drawings are going to be excluded if they are going to be taken by the owner, any type of thing for their personal use. There's some limitation of statement of financial position. First one is the valuation historic cost. It means the value of assets and liabilities at the time of acquisition, not their current market value. This can lead to significant difference between the book value and the actual worth of the business. For example, a building purchased 10 years ago will appear as original cost in the statement of financial position, which may be much lower than its current market value. Other one is omission of significant assets like assets, the brand reputation or employee expertise are not included in this statement because they cannot be measured reliably. This can result in incomplete view of the company's true value. These are the references or list down here from which all the information is going to be provided in the previous slides. Thank you everyone. And if you have any questions, you can send email to me. My email is mentioned in the module handbook, and you can also send email to other lecturers as well. Thank you very much.